The bulls charging into the second quarter, extending the S&P's double-digit gains this year. For more on the markets and which names have been leading the charge, let's get to Bob Pisani at the New York Stock Exchange. Hey, Bob.
Hello, Melissa. The S&P just finished its best quarter since 2009. Not bad. You know, it's rare when you get large cap stocks, mid cap stocks, small cap stocks. Look at this, all up double digits, all up the same. The gains are broad-based, though. Technology stocks were the biggest gainers, up 21%. Industrials, which, remember, were dramatically oversold at the end of the fourth quarter on global growth concerns, they snapped back as well. They're up 19%. And energy stocks also were strong as oil rallied from $42 at the end of December to nearly 60%. That's almost a 50% gain. Not surprisingly, some of those most oversold stocks at the end of the fourth quarter, they've been the market leaders. This always happens. The energy names like Hess, guess what? They're up 50% as oil rebounded. Others like Celgene, well, they jumped on the merger news. Remember that was that Bristol-Myers story a little while ago? Chipotle, Coty, chipmaker Xilinx, they were much higher on strong earnings and guidance. Overall, though, 90% of the S&P 500 was up in the first quarter. That's also a rarity. For the second quarter, it's all about the economic data. Just look what happened today. Global markets rallied because the China manufacturing data was much better than expected, and it played perfectly with the bull narrative that China's economic weakness will bottom soon. Now, and we had better than expected ISM manufacturing numbers and construction spending numbers. They came out 10 a.m. Eastern time. The market took another lift to the upside, and particularly bond yields moved up. Banks moved up as well. The calendar's a big help for the bulls. April is the best month for the Dow Industrials. It's been up 13 straight years in April, and the third best month for the S&P 500 after December and November. The calendar smiles on us. Melissa, back to you.
All right, we'll see if it holds true this time. Bob, thank you. Bob Pisani at the New York Stock Exchange. Who believes in the calendar still?
I do.
You do?
Yeah, I do. I
Okay.
mean, maybe this is my emerging market background, but typically what we've seen is the best time to buy equities has been kind of early March through to the end of April, and then you get into the sell in May, go away. Some of this is really the seasonal side of just investing out of the year in allocations. Some of this truly has been, you've seen a lot of the volatility over the summer. It's been a place to stay away.
I just think that we're front-loaded. As much as the calendar is important and you have to pay attention to it, the seasonality is very important, but a lot of this has been front-loaded. We've seen such an aggressive bounce off that December low that it's hard to imagine what goes into the calculus and what's not in, what's in, and what's still seasonally adjusted. But I think it's more of positioning for a lot of these accounts going forward.
Bob had mentioned a few stocks that had led the charge in the first quarter. I don't know if you were...
I listen to every Hess up 50%.
Right.
I hear everything. I pay every
Chipotle,
attention.
Xilinx.
I'd like locked in.
Anyone
what
that you would
what
still
sticks out to
buy.
you? Boeing. Did he mention Boeing? Probably not, but he mentioned industrials. And
That means you weren't listening. You're just throwing something in.
Is this the
no, I
Doors
was
side?
listening. I was absolutely listening. I'm adding another name to the list.
Hey.
And if you look at the amount of volume Boeing traded during the trough of that news cycle, it was ridiculous. Boeing doesn't trade like that. And I think, and we said it a sort of 2 or 3 weeks ago, there's a very good chance it'll come back month and a half, and Boeing will be right back to 430. Well, it's gotten 20 of those dollars back.
All right, our next guest says it is time to take profits in some of the big winners this year, but there is still one name looking like a buy. Carter Worth, the Chartmaster, is over at the Plaza to break it down.
Well,
Hey, Carter.
There's more than one to buy and there's more than two to sell, but I've got three names for you. But first, let's talk about the market a little bit. We just heard, obviously, from Bob Pisani, it was the best quarter, Q1, since 09. Well, the preceding quarter, of course, was the worst quarter since 08. You get a big ricochet after a plunge. We heard that 90% of all stocks were up in Q1. 98% of all stocks were down in Q4. So we have this V, and that's the issue. Is the V enduring or is it not? But what we know it's done is basically return us to the level where the market is stalled out before. Right, so the actual equal weight S&P, as opposed to the equal weight couldn't even make the high. The S&P made a slight new high. And as I would draw the lines, I think basically we have been in the process of topping for the better part of 14 months. This reading right here, right, that's January of 2018, that was the highest weekly RSI ever recorded on the S&P, including 1929, 1987, 2000. And basically, we've really never progressed since then. Most sectors have yet to go back above that high, and most global bourses, with the exception of the Bovespa. So my own hunch is, right, is that we've had a nice rally, it's all very impressive, but that we have the risk of this kind of thing coming. And that it's not just this great off to the races kind of thing. And even were that to happen, I suspect it would be yet another trap, and that we would really have the ultimate in a topping out formation. Equities have been topping, the data's been topping, and bond yields tell us this. Anyway, let's pick some stocks. Here we go. So, two that are a little hot, a little overdone. American Tower, Chipotle versus the S&P. 1 month, you can see the spread. 3 months, you can see the spread. And 6 months. I mean, these are gargantuan winners. American Tower is a very important stock. We'll look at that at the end. But first, look at a basket of these two names. This would be the two combined $100 billion in market cap. And what essentially we have here is something that's basically off the chain. Yes, a 50, 60% move as an aggregate. Now look at the individual stocks. It's really the same circumstance. Here's American Tower. REITs are so important, of course, that we have a GIC sector now. This is the biggest REIT in the world. It has towers all over the world. We all use it when we use our cell phones. Almost $90 billion in market cap. And my thinking is, you take some profits here. Guess what? It was down today. Not many stocks were down today. That tells you no incremental buyers. Well, here's another one. Chipotle, not as important, of course, but still $20 billion. It was also down today. Just a little too hot. And the thinking here is, take some profits, a little too steep. By comparison, consider a stock like this, which has made no progress in a long time, but is setting up so well. Chartists like to draw lines. We can draw them one way, like that, a head and shoulders bottom. The implication is a breakout. You could draw them like this, a cup and handle. The implication is a breakout. You could draw them like this, well-defined wedge, just taking out the highs, breakout. Or you could just say, hey, look, it is a breakout. It's already taken out the highs. There's always something to buy. There's always something to tell. Things that are too steep, I would take profits. Things that have made no progress in 6 months, put some money to work.
All right, Carter, why don't you come on over to the desk? Evan will bring the chair over.
With the annoying music.
Sir.
It's the
Thank
fake
you.
music because we're not allowed to play.
There it is. You know, there's no. You're supposed to leave things for people like a greeting.
Welcome.
All right.
So Carter, I'm curious, in terms of the chart, the Norfolk Southern chart, I would think that chart looks like a lot of different charts in the markets where the stock hasn't done too much. It had sort of that big bottom in the month of December, and it's back to levels that it had been at the fall.
Well,
so how does that
to some
set up
extent.
differently?
So there are a lot of stocks that have made new highs. Certain tech names, right? We know REITs are all making highs, utilities making new highs, certain consumer discretionary names, and a lot of names are nowhere near their highs. Most industrials, most financials, and so forth. NSC, CSX, actually UNP, the whole group, the thing that appeals to me is how well they act, because truckers, not good. Airlines, not good. The big package haulers, FedEx and UPS, not good. And yet rails, because they're defensive. They're the defensive element within the transport side. People are hiding there, but that's not necessarily a bad thing. People hide in very defensive names. Microsoft is defensive. Visa is defensive. In fact, if you were to just look at the V that is the market, right, where we were in Q3, the plunge, and where we are now, so that 6 month period, let's just say we're back to where we started. Guess what's led in that 6 months? Number one, utilities, REITs, staples, and tech. That's all defensive stuff. That's the story of the market. The ricochet is impressive, but all we've done is return to where we were. Now the market has to prove itself.
So wait a second, Carter. So you're telling me that Norfolk Southern, all the rails are ripping. That's defensive. Today we saw airlines, we saw truckers, we saw the rest of the transports do well. And your other chart, AMT, which was bought because it was the biggest part of the REIT index for yield, reversed. To me, I look at that market and say everything that's happened, all that defensive movement has changed today.
Well, that's the exact reverse of what I was just saying. Meaning, if you were to look at the 6 month period, the things that have led, utilities, staples, telco, REITs, and so forth, on any given risk day, you can look at your charting services. It's always industrials, financials, materials on top, energy, and then it flips and it goes utilities, staples. So it's risk on, risk off every given day. But what we know is one day doesn't change anything. The key to rails is they are actually defensive. They are monopolies, essentially, or duopolies, whatever you want to. I like them, but it's not quite the bullish thing I think it would suggest.
So, Carter, if earnings do disappoint, and if they're not already factored in, and if guidance is where, see, the problem is we're so aggressively tilted towards the consensus angle that it's going to be terrible on both the EPS front and the guidance front. If they do fail to the point where they surprise the market, where can the S&P go in your mind? Where are the check back levels? Are you thinking about?
Well, you and I have talked about 2,600,
yeah.
and I think that's as good a reference point as any. Meaning, we're right back at the highs, and while individual securities have made new highs, some like AMT much too hot. The broad thrust is that global equities, it's not my stat, it is the stat. They peaked in January of 2018, There are no bourses essentially that are higher than that level except for one or two. And it's a prove it now, right? Because what happened was we dropped more than 20% from an all-time high that has only happened 11 times in the history of equity markets for the S&P. And yes, we've recovered, but now just getting back to where you were, now it's proof.
Carter, good to see you.
Thank you.
Carter Braxton Worth with the beard still. I thought he'd get rid of it over the weekend, but
Happy he didn't. He's like a
Not
young
usually-
Glenn Campbell.
I'm not usually a
Nice
big
call.
fan, but
Rhinestone Cowboy.
That's nice.
He's a handsome man.
How do you reconcile the technicals or what Carter Charter has laid out versus what you view in the markets?
So he's talking about the S&P, and clearly the defensive elements are hard to deny what's been working. But then you also have the stuff that really was kind of bombed out and is now or started to pick up some life. So I still think that materials, industrials, the rest of the world, it's hard to argue that stuff which was really badly beaten down hasn't been leading a bit. And I think that's encouraging to me. I would stay in that trade.